I request all of you to write down a further note for this. We can conclude that between two financial plans, comma, a financial plan having lower financial charges will be selected for expected operating income lower than financial indifference point and vice versa. Full stop. A company would be, read on further, a company would be able to bear burden of fixed financial charges only when it has income. Full stop. So when your income level is low, at that time, so it is not possible for you to bear the fixed financial charges burden. That is what we understand. So I give you a summary of the entire answer. In this question, the question says that we are basically going to have so the funding of an amount of 3 lakhs in the business. For the purpose of making investment, we are having so the two alternatives. Either we can have completely equity financing or we can have the debt equity component, that is debt equity mix. 1,50,000 of equity and the remaining is the outsiders funds. In the first working note, in the first question, we have to compute the earning per share for first financial plan for expected EBIT 30,000 and the same working for the second one. The same working is required to be repeated for expected EBIT 1 lakh. That is the way the EPS is calculated: 0. 0.6, 0. 0.3, 2 and 3.1. This is what we have done. Second question is calculation of the financial. Friends, in the second working, I have made a small mistake. This is financial indifference point. I'm sorry. Uh, Financial indifference point is indicating the level of the EBIT at which both the financial plans, at which EPS of both the financial plans will be same. That is at 30,000, first financial plan has more EPS, and at 1 lakh, second financial plan has more EPS. So between these two, there is a financial, that is said, there is a level of the EBIT at which both the financial plan will have same earning per share. That is what say we are supposed to calculate. For that, say I explained you the EPS formula, then financial indifference point. In that, say the EPS of 1 is equal to EPS of 2. We'll solve the mathematical equation to compute the answer. It is 45,000. We also checked at that point of time EPS is same 90 paise. Third question is financial break-even point. Break-even point is always to be understood a situation of no profit, no loss. So we are calculating again the level of the EBIT at which EPS is 0. That is, for that, so we have a formula like this: interest plus preference dividend divided by 1 minus T. It is computed for first and second financial plan. Dear students, the first financial plan is unlevered, second one is levered. So accordingly, we make the calculation of answer. For second financial plan, it is interest plus preference dividend divided by 1 minus T. So it is 7,500 divided by 0.6. So it is 12,500. Technically, it is given a name as making it pre-tax plus interest. I also explained the formula to you. Fourth question, in that, say for each of the level of the EBIT, which financial plan to be selected? For 30,000 it is 1, and for 1 lakh it is 2. Then importantly, we understand this small table, which I think is very important for you to understand. For expected EBIT greater than 45,000, we'll select the second financial plan. Why? Because it has more financial charges. And lower than 45,000, first, because it has comparatively lower financial charges, or no in this case. Exactly at 45,000, you are indifferent between both of them. Then accordingly, I have explained you this diagram. 45,000 is the level of the EBIT at which EPS of both of them would be same. The starting point of the each, like financial plan 1 and financial plan 2, is the financial break-even point. For financial plan 1, the break-even point is 0, and for second, it is 22,500. And as a student, what I think is that this conclusion is most important that you should understand in this question.